Is the economy toast? That's the central question. We do know that the economy is growing at the weakest pace in a year, and while growth is slowing, the big question is how much should we be worried? Listen to Reagan budget chief David Stockman, also former Fed chief Alan Greenspan. They're warning about what's coming.
For the markets to conclude that everything is all better, that we're moving upward ever higher, I think is a huge error. And when we actually get to where I think we're going, which is a recession, there will be massive panic in selling on Wall Street.
When is that recession coming?
I would say by the end of this year or next year.
We're running at the end of this period to a state of disaster unless we turn it around.
Gary B. Smith agrees about all of these big problems, but Jonathan Hoenig says, hey, just chill out, be cool, not just because it's a Friday, right, Jonathan? Hey, I'll start with you, Jonathan, to keep our optimistic theme from Stuart Varney going here.
Well, markets tend not to crash, Charles. They tend not to collapse. So all these Cassandras who are always warning about this imminent collapse in stock prices, it generally never seems to come. Now, that doesn't mean that we're not in for a rocky ride. In fact, I think a lot of this intervention from the Federal Reserve and from government is going to come home to roost in the next couple of months. But I think it's much more likely to end up a period of stagflation, not unlike the U.S. in the 70s or Japan in the last 20 years, than a mammoth collapse like David Stockman's talking about.
You know, though, Gary B. Smith, we do have to separate, though, the stock market from the economy from time to time. Let's face it, we've had a very flaccid recovery, and the market's done very well.
Well, I agree with you. You know, Jonathan says potato, I say potato. So maybe we're talking about two different things. Although, at this point, a 10% decline in the stock market, which would obviously not be a crash, would, you know, throw the jitters into a lot of people. I look at the two parts of the economy. You got the corporate part and you got the personal part.
Right.
Let's look at the personal part. We're nearing credit card debt that's almost $1 trillion. That's the highest it's been since 2008. And remember how well that went. We know consumers aren't spending. Look at Macy's, look at Apple. They're not out there buying. And on the corporate side, Charles, we've seen the greatest decline in profits since the Great Depression. Corporations are not making money out there. So I'm looking around. I'd like to be optimistic like Jonathan. I don't see the bright spot right now.
Well, Jonathan, let me jump into it with you guys. You know, today in the GDP report, it was a tale of two entities, if you will. Corporate America, once again, they're not only not making money, Gary B., but they're not spending money. They're not investing money. But on the other side, 17% growth in residential investment. It feels like we got a housing boomlet. Jonathan, is that sort of thing enough to offset all the negatives?
Well, a boom is not a bull market is not necessarily a bubble, Charles, and I think there's bullish signs all around you. I mean, even look at today in the stock market. But Jonathan, let me ask you,
on the stock market and the economy, I think we're talking two different things to Gary's point. Obviously, the economy, no one could argue, not even President Obama, that it's going gangbusters. On the other end, can this stock market rally withstand this sort of this continued weakness in the economy?
Yes, Charles. In fact, I think the market tends to lead the economy. And I'll tell you, by the time all the economic numbers start to improve, that's when you want to start to be worried about the stock market. I think I'll quickly say the big fear moving forward is actually going to be inflation. And, Charles, you know, you talked about the average Joe. He and she have not seen their earnings go up, where we're going to start to see prices going up. You've seen it not only in metals in the first quarter, but a lot of the soft commodities now, oil as well. So I think we're headed towards more of a period like the 1970s. Stagflation, lower unemployment, higher prices, and lower economic growth for all.
Stagflation doesn't sound too good. Gary B., I remember the 70s, and it wasn't a fun period to live through. I know you had a few stocks like the Nifty 50 that did okay, but again, trying to separate the two and help the audience here, how do they approach this from an investment point of view, Gary?
Well, let's a couple things before we get to that answer. One, the 70s stunk. I lived through it. Long gas lines. The market,
but you love the music.
Horrible. Two, that you've talked about the housing market, those new home starts, that's just a small percentage of the market, Charles. You know that. It's existing home sales that matter more.
But they're doing well, though. They're doing well, though, Gary.
Well, it depends on the price range you are. Yes, if you're like $200,000 to $500,000 in Washington, D.C., you're in great shape. If you're anywhere else outside that, not so good. Now, what should people do? I would be in foreign markets, for one. because I think they're undervalued, and I'd also be in bonds right now. I think being totally invested in U.S. stocks is a little bit risky.
All right, guys, let's leave it there. I love talking to both of you. Have great weekends no matter what. Let's keep the optimistic theme going.